Welcome back, everybody. This is video 4 and probably our last video for chapter 11, so bear with me here a little bit. We are looking at budget deficits. So what's left in this chapter is to understand that there are budget deficits and there are budget surpluses and there's a balanced budget. Obviously, a balanced budget, all the revenues coming in equal all the outlays going out. Not very likely to happen, specifically when it comes to governments, because governments are doing more than just trying to function and exist for themselves as a government, like run, for instance, courthouses or the military. They're also trying to be a counterbalance to what's happening in the private sector, because we turn to our political leaders and we say, save us from our troubles and do something, right? We like do something to the politicians. And so what they do is they try to say, well, what can we do about the taxes that we are imposing on people? And what can we do about how much we are spending? Now, what's a budget deficit? A budget deficit means the government is spending more money than it has. Kind of like when any individual gets into debt, right? The government outlays exceed, right here, the tax revenue. So how much is coming in is too small against how much is going out. So this is from the Wall Street Journal here a little bit. So what's happened with federal budget deficits or surpluses over the years? And so if we were to look a little bit here, we look at the 90s, where we had, right here, you can tell that there were budget deficits. But then in these years, in the early 2000s, in these 4 years right here, there was actually a budget surplus. And then mostly a budget deficit. You will find in general, our economy experiences budget deficits, which means we are adding to the overall debt from year to year. Our federal or national debt, we add to it from year to year. And predominantly wise, right here, I want you to notice this here. Wars and recessions are massive contributors to budget deficits. And because the United States has been either engaged in some war or fighting some sort of recession or both, most of the years that it has existed as a country, we look at having more often than not a budget deficit. Budget surpluses are well suited. If you look at economies that, are cash rich as far as governments go, and they have rainy day funds and they don't really have much in that, they tend to not engage in war, and they tend to have recessions that are either milder, or when the recessions happen, the governments don't overstimulate. But they just basically face fewer recessions, and they face almost no war. I mean, it's been hundreds of years for some countries like Sweden or Ireland since the last time they actually had an official war. You basically have to go back to the 1800s or earlier to find that they've had any. So this definitely is going to spare them from having to incur massive budget deficits like in this picture. So typically we do have budget deficits. Since 2015, this goes up to 2015, we have had only budget deficits. We had the Great Recession right here. You see that this massive budget deficit here, and this is where the Great Recession was. 2009 was the absolute worst year, started in 2008. In 9, there was a massive compensation. 10 and 11 weren't so hot, and there was definitely a gradual improvement. So when we say we are improving, we are saying more, we are going into a lower deficit instead of higher. But we've been reversing the trend since COVID, because COVID came and suddenly the economy came almost to a halt, and then the stimulus money started rolling out, so the government was again spending more than it actually has coming in. So this is our budget deficits over here. Now, what's a budget surplus? A budget surplus is the opposite, right? I need an editor. So budget surpluses are when the government outlays actually are smaller than the tax revenue. So the government is spending less than it's actually taking in income, like in these 4 years right here in the late 90s and early 2000s, right? Those are the 4 years I showed you earlier. This one is a graph that's doing some projection. So the other one stopped at 2015, which would be here, and you can see how basically there was a gradual reduction. And then you see that it kind of started to, get worse. And now we have some projections. And if you look into the future for some of the projections past, here's 22. 22 is worse than before. And, it's just the way it is. In 2018, we started to increase. The reason 2018 we ended up with more deficit than before is because of that massive tax cut that bill that gave pretty much people who are wealthier a bigger tax cut than people who are less wealthy. So it benefited it the most. And, by all means, look up this information. You start to see that the government here was collecting less revenue than before, and consequently they had to borrow to compensate for the income that's lacking, that's not coming in as before. Then we see here what's happening is all that stimulus that has come the last couple of years because of COVID, and the projection is it'll probably have to continue in that trend for the future. So that is one of the things we keep an eye on and see what the CBO, how they adjust it in the next year or two. They might adjust it a little differently, but for now, that's the projection. So we don't have any budget surpluses in our future. Let's put it that way, any foreseeable future. The last point to be made here is, what is supply side fiscal policy? Okay. It's called supply side. When you use just demand side, right? When you just use the word fiscal policy, you mean demand side. In order to distinguish fiscal policy from supply side fiscal policy, that's what we call it, supply side fiscal policy. So let's look at them a little bit here. The demand side, which is typical fiscal policy as Keynes wants it, can use monetary policy to cut interest rates, but not necessarily a favorite of Keynes, because Keynes doesn't think that we should really use monetary policy very much. But if the interest rates that are being cut are going to affect a person's mortgage, credit card payments, any interest that might be adjustable due to changes from the discount rate from the Federal Reserves, then this is going to help. Fiscal policy, in this case, cutting tax rates, right? Where the government says, okay, at least for X number of months, or well, years usually, it's X number of years, 2 years, 3 years, we're going to reduce taxes by this much per category, per tier. Well, this is going to be a stimulus. A devaluation. This is actually monetary policy here, and lots of countries do that, where they purposefully devalue their currency in order to be able to export more and import less. And so now it's net exports that are coming in to stimulate that economy. And quantitative easing, and I do have some information for you on your exercise about that. And quantitative easing is basically when the government adds more money to the money supply. And the last thing we're going to do together is look at monetary policy. So really in this one, 1, 2, 3 are monetary policy. And fiscal policy is more powerful than monetary policy, but it could be sometimes slower acting. Because first you're going to the buyer, and then you're waiting for the buyer to take the action. So for the seller to react, that's a little bit slower. But it is more powerful, more impactful, and longer lasting. That's demand side. Supply side now. Look at supply side. If you're a Keynesian, you pretty much hate all of this. Privatization or deregulation. Well, in this case, what we're saying is we want to make it easier on businesses, right? So we want to take some things that the government does. So when you hear people saying, let's privatize the post office because it doesn't make any money, so then you can no longer have the government service mail in any shape or, or form, that's a type of privatization. Deregulation is when we actually hurt the environment, for instance, because we're saying not every deregulation is bad. Some deregulations are warranted, and it's about time. So some deregulation is beneficial, but usually when you're applying supply side fiscal policy and it's a relatively short-term hit and change, it may actually backfire, may not be the best regulation. But the point is deregulation. Investment in education and training, in this case, you're going directly to, it's probably a very good thing, but in what way? So we have to be vigilant of that. However, if we go and give businesses money so they train employees, for instance, this qualifies. More flexible labor markets. What we're saying here is we want to do something about not having a minimum wage or lowering it or not raising it. We want to weaken the impact of unions. You see down here, it says reduces power of union. This is really tied to creating more flexibility here for labor markets. The deregulation is really about businesses also, for instance, maybe being able to hire people that they couldn't hire before, maybe easing the qualifications, maybe changing the age requirements, maybe changing the legal status, anything that has to do with just creating more access to cheaper labor and reduce tax rates. But obviously, in this case, it's a business tax rate. So you're not giving it to individuals like you would in fiscal policy. For this one, it really doesn't say anything about government spending, but it should. This comes from a British beautiful website about economics, and so it's a little bit modified, but it makes the point beautifully. So here we are. We have concluded our discussion. about Chapter 11. I always love having you. I enjoy you. I hope you have a great rest of your day, and I will see you in our next chapter.